5 seconds and 3, 2, 1. And here we are.
All right. It's the weekend again.
Comes every week.
It comes faster and faster as I get older and older. That's the problem.
Well, the weekend's not long enough, that's for sure.
No, it's not. Especially this week. This was quite the week that is just still never ending.
No.
Oh my God.
As of recording, we don't know who Deprez is. And at this point, man, I just want to get on with it.
Honestly, like we were talking about before, my aperture wasn't wide enough, and at this point, I'm happy for whoever to win. Because
let's just get on with it.
Obviously, the market likes it.
All right.
Right? And I don't care who wins as long as the market likes it. I'm good.
Yeah.
Right?
The market is our focus. What do you got for us this week?
All right. Weekly update, 8 November 2020. So forgive me if I have already used this quote, but I like it, and I'm going to use it again this week.
Amen. You're the guy in charge.
Too many people spend money they earn to buy things they don't really want, to impress people that they really don't like.
What if you don't like anybody?
Then you're probably buying a whole lot of stuff. I mean, William Penn Adair Rogers was an American stage and film actor, performer, humorist, newspaper columnist, author, and social commentator. I'm sure he would have loved to be commentating the stuff that was going on.
That's a long list of stuff.
Actually, I cut it down a little bit. Right. He was a Cherokee citizen born in the Cherokee Nation Indian Territory, November 4th, 1879. Died in 1935. So a whole lot of wisdom in history. Anyway, I do know about you, so I'm not going to say I don't know about you, because I do know about you. Spending money, earning money so you can spend it on stuff that you don't really want to impress people that you don't really like. I mean, it took me until I was 50, and I'm only 52, to figure out the wisdom of Will Rogers' statement.
No doubt. I think there's times in my younger days that I didn't know why I was doing it, but I was following that rule. Yeah. We just weren't consistent enough.
Yeah, it's tough. I tell you what, my son one time was like, I don't even, we don't have any money to do other stuff. I don't even really like living in this house. And I'm like, oh, let me think about that for a minute. Like I am putting all this. I just didn't look at it from his perspective necessarily. Right. I made assumptions that really weren't. It was trying to get along with the Joneses, and it just, it was a mistake.
And thankfully, your kid didn't care about the Joneses.
No, he didn't. None of them did.
That's not always the case.
Yeah.
But, you got some sharp kids, though.
Yeah. So, anyway, take it for what it's worth. I like that quote, and I'm definitely living by it now in my minimalist way of looking at things. Okay.
Wow.
So, yeah.
That's a lot of stuff.
I had to make the font smaller. A lot of things happened in the market this week.
All right. I'm going to let you get on with it. I'm not going to stay out of it.
All right. Well, hold on. I got to think for a minute.
He's got to have a drink of coffee.
The ice rattling around in my coffee.
It's not coffee.
Okay. So, before I forget to say it, let me just read this part. I had planned to focus the show on post-retirement options. Right, what to do with your TSP account when you retire. A lot of folks have been asking for us to do a show about that, but because the week was what it was and how it played out, I decided to push off that topic for a little bit, but we will definitely come back to it.
We will come back.
Yeah, that's a big one.
We'll get back to it.
For a lot of reasons, we're going to circle back to that. So the market this week, right, by that I usually mean the S&P 500 or the C Fund, was up over 7%. To kick off the week, to kick off the month of November. It was the biggest week since the follow-through off the March lows. So it was a huge week for the S&P. On Tuesday, the S&P gapped up and closed right on its 10-day moving average line, right? Then on Wednesday, the huge gap up at the open began the daily trading above. So when it gapped up on the open, it was the beginning of trade for that day above both the 10-day and the 50-day moving average. So the gap up on Wednesday, and really more importantly, the continued price advance on Wednesday morning is what led to the alert that we issued late Wednesday morning. Thursday, the market continues higher by another couple percent. And finally, on Friday, it paused a little bit. It was basically flat. So the C fund was up a little over 7%. S&I funds did even better. They were both up a little bit better than 8%. F fund had a great week, gained about 0.69%. Actually it was up over 1%, but gave back quite a bit of it on Friday. The F fund is our last chart in the deck here, and we'll talk about that a little bit when we get to it. So yeah, it was a very explosive week, both in terms of volatility and volume, and we'll talk about it here as we move forward. The focus, well, I say we'll talk about it. We're gonna put up all the charts at the end, but the focus we want to talk about right now is a review of the most recent alerts. So the two pieces we're going to look at is making reasoned decisions versus not emotional decisions.
That's supposed to say emotional.
Supposed to say emotional. Emotional decisions, reasoned versus emotional. Okay. The second thing is going to be the wealth building mindset versus the day trading mindset.
My favorite topic.
Yeah, we just talked about that, right? Let's see. Okay. I want to go back to this for a second. All right. So last week we spent a lot of time on this idea of locking in losses, right? We showed the math on how $100 can turn into $120+ with a 25% loss in the market, right? Even when you lock in, quote unquote, lock in losses of 5% off the top, and you miss 5% off the bottom.
Yeah, and if you guys don't know what we're talking about, go back and check last week's weekly
last
update.
Week's show.
We won't go through the whole scenario again, but basically we showed in simple terms why it does not always work to just ride out the market.
Right. Why locking in losses is not the end of the world.
It's not a bad thing.
It's not always a bad thing at all. No. So that was a theoretical math problem, right? Today we're gonna apply that concept to the last few months of trading, and the alerts that we put out over that time. So we posted 5 alerts, including this week, from the end of August through November 4th. During that time, the market carved out a W, basically. I just lost train of my thought. A W pattern, and the
you
range.
got a lot of notes there.
I got a bunch of notes. The range of that W pattern, which we're gonna, as soon as I go to the chart, you'll see it. The range is about 10% from top to bottom as we go across. So we're gonna look at a chart that shows exactly why we made the reallocation decisions that we did and posted those alerts, and then we're gonna look at a chart a little bit longer term and talk about wealth building versus day trading mindset. And then finally, we're going to look at the 3 stock fund charts and the F fund chart to get an idea of where the support and resistance lines are now and going forward. Okay. Am I on still? Yeah, I'm on still. Okay. All right. So we talk about all the time, rule number 1 is don't lose money. And rule number 2 is you need to be in the stock funds when the market is trending up to grow your TSP account, right? So in this chart we're looking at here, 1, 2, 3, 4, 5, 6 month daily chart of the C fund.
You might have to zoom in on a couple times. Just
yeah, I'm gonna end up going back in and out a couple times. So last week we talked about perspective, right? The importance of understanding the charts across multiple time frames. We're going to start by looking at this really short-term perspective, the last few months, the last few months of trading. So if it's short-term perspective, we're going to get to this later, but it's much more along the idea of day trading than it is about wealth building. But so let's take a look and see what happened. We got, let's see. I didn't put this up here, but I know that July 2nd, I did an alert that took us back into the stock funds. Okay? So for this whole gain, we were in the stock funds, more or less. There was an alert in here around this, but more or less we were in the stock funds for that gain from July to September. Okay? On August 31st, we put out an alert that put us, zoom in on this one. August 31st, I put out an alert on that red day. Okay, that's the closing price on that red day. We went to evenly distributed, right? 15% in C, 15% S, 15% I, and 55% in G. I do that to make the numbers work, right? It was basically 50-50 stock and G, but to make the numbers work easily, I just did 15% across the board and 55 in G. It's not a hard and fast rule. It's just what I did that day. So on that day, we basically had this whole gain right here. On this day, we locked in 55% of those gains. Okay? So everybody talks about locking in losses. On that day, we locked in 55% of those gains. So then what happened? 2 days, the market goes for two more days and then collapses. And in these 2 days right here, it broke the 10-day and went all the way down to the 50-day moving average.
In a 2-day time span.
Yeah, in 2 days.
Not over a week. 2 days.
I mean, it made it almost down to the 50. So really, if you want to call it a third day, but it collapsed through. There was no getting out of it. So we were lucky, right? We were only 45% in the stock funds during that little correction. So we have a lot of room to work there because we didn't take the full extent of the losses. We only took 45%, 45% of the losses. So then we watch as the market consolidates. We're looking for support at the 50, and we get it, and we can see the market's consolidating here, right? So one of two things is going to happen.
Up or down.
Up or down, right? And you don't know until it happens.
Because we're not timing the market.
We're not timing the market. We're doing what the market tells us to do, right? So what happened? The market went down. And once it went down, we got out. Because why? We don't know how much further it's going to go.
Right. 21 September, we're 100% out.
100% out.
Because you have no idea how far it might go down to the 200-day moving average.
Red line. I'm sure we've talked about it either on the update show or in the newsletters. Yes, I have expected.
There was a high probability.
Yeah,
there was going to go down.
It was going to go down to the 200. Yeah.
It didn't.
It didn't.
But that doesn't mean it wasn't probable. Right.
So plan A was that it was going to go down to the 200. Plan B, which you have to have, right? You got to have the plan B, was that it didn't go down there. So what happened? It came down to 3,200, reversed, came back up over 2 days, and then gapped up above that 10-day moving, above the 10-day moving average. So in this, where we were then, we consolidated sideways a little bit in between the 10-day and the 50-day. So that means it's getting resistance on the upside
and support
on the downside. So
it's
until
it's kind of stuck.
And for our purposes, you can't go anywhere. You got to just let it play out because it's bouncing back and forth between the two. Right?
If we had 50 moves a month, we wouldn't have to do that.
Oh yeah, that's a different thing, right? If you could move every day,
we can't.
It's a totally different thing, but we can't. So what do? We wait until the market tells us which way it's going to go. And when did that happen? October 1st. Right? October 1st, clearly we had to move higher above both the 10-day and the 50-day.
Right.
So what do? We said, well, we're not 100% sure. We'll go 50% in.
Right. And let's take a second to talk about, personal risk, right? So I want everybody that watches this to grasp, well, why 50-50? What's the magic there? Like, what told you to do that? what told us to do that was our personal risk tolerance of, hey, I'm not confident enough. There's not enough in there that tells me this is going to be a for sure swing up. Like no doubt it's going to keep going. There's not enough there to tell us that. So let's get in, take advantage of it, but I'm not all in.
Right.
I'm not all in because there's just not enough data to support it. So why I point that out is if your personal risk tolerance is much higher, if you can tolerate risk in your portfolio of funds in the TSP, maybe you go 100% in.
Sure. Why
we put the allocation out is for you to validate your decision based on all of the technical analysis that Jerry does, right? I know I'm sidetracking us just a second,
okay.
But it's a good place to show why 50-50, why 55 and 45. Sure. Well, you might be 100 or you might be 75. You have to decide. My allocations might very well be different than Jerry's, even though we're following along the same charts, because my risk tolerance may be lower or higher at any given time.
Right.
You guys have to get into this mindset, those that are watching us, particularly members of the site, that you have to come to, no offense here, this is a kind of a country term. You got to have a come to Jesus moment, right? You got to have a come to Jesus meeting with yourself and say, okay, am I going to sleep okay at night being 100% in?
Yeah.
If you're not, then don't, right? Yeah. Because, you've been doing this for 20 some odd years. You got a good gut feeling based on, it's not a gut feeling. It's based on data. But there's a little art to it, and it's built, your allocations are built on your personal risk.
Yes.
This is your account.
Yes.
This isn't some notional TSP account.
Nope.
This is your real money.
Yep.
So I point that out because I think a lot of people glaze over that and think, well, why didn't we just get all in? Well, that's your money.
Yeah. If you want to get all in, do it.
You get all in. But Jerry's money or my money or someone else's money, that's not the same.
Right.
And it's important to note, you could have gone, can we go back to the chart? Are we still on the chart? I got to put us back on the chart. I clicked the button.
Okay.
So I just think this is important again from the kind of the layman side of this, right, where we're not as involved kind of as Jerry is. When Jerry says 50% G, 25% S, and 25% C, you've got to understand that that's where Jerry's risk tolerance is at and his confidence level or not confidence level, right? And so if you say to yourself, no, I'm okay taking this risk. I'm going 100% in. That doesn't mean you're out of sync with us, because you're in.
Right. True.
How much you're in is how much you're in. My point is some people get kind of wrapped around the axle about, well, I'm off sync. Well, sometimes it only matters when you're off sync on the up and down. Yeah. Right? If we're in and you're in, we're synced.
Yes, true. That's true.
How much you're in is how much you're in.
Right.
When we're getting out, if you're all in, now we're out of sync.
Yeah.
Does that make sense?
It does.
Am I explaining that correctly?
I mean, absolutely.
So because I see a lot of the comments and the discussions, in our group, and we get emails all the time, and I think people lose perspective here of what we're trying to accomplish, which is to educate you and to validate your decision.
Right. I mean, we all. I mean, let's be honest, right? Our goal, our stated goal is that we're an educational website, and I know because I talk to people every day. I know there are people out there that are doing exactly what you're saying. They know that their risk tolerance is different from ours. They're either retired or they're young.
Yeah.
Right. And
I talk to them
every day.
We could call them out on the by name.
I could, but
they're like, "What, dude? I'm all in." Or, whatever. But that's okay.
Right. It's fine. And we can have conversations about why do you think this and this is what I think, and okay, great. I mean, make the decisions you make. That's awesome. That's one percentage of the group. The other percentage of the group, or another percentage of the group, are guys that just say, you know what, you guys are great, and I'm just going to follow what you do.
Yeah, if you have that confidence in what we're doing, then that's fine. And that's and to be completely transparent, I'm going back on us. I'm hitting the wrong button, guys. Sorry. I'm getting into this conversation, as you could tell. I'm passionate about this because I started as a guy that literally didn't care about all the analysis. Jerry sent out the email. I changed my stuff. I didn't think about it. I just pushed the button. I did it, right? as I started to learn more and more about it, I got more interested. That's a whole separate story. The point is that may be you out there listening to us. You don't have to be any certain place in this line. You could say, you know what, I don't have time to do all this.
Right.
Now, what we're hoping is that we can educate you enough that and there's a few people that made this comment in the Facebook group this week where, hey, it really only takes about 10 minutes or 20 minutes, maybe not even that long, 30 seconds to just look at the chart and go, oh, wait, hey, that's an indicator. Oh, well, let me find out. Then you kind of know something's going to come. Right. And let's get back on track.
Yeah, you don't need, I mean, these alerts are important, no doubt about it. And, the timing of the alerts and everything is important. But if you understand your own risk tolerance and you know the moving averages and you got your finger kind of on the pulse of the thing, you don't when the market gaps up or down, you don't need me to tell you what to do.
Yeah. But it is nice. This is why we started sharing that. It's nice to be able to validate it. So so I've got it 70-80% figured out. I see what Jerry does and I go, "Oh, yep, I'm confident now because I know someone else who knows what they're doing is doing something similar."
Similar. Yeah,
right.
Something similar.
That's the key. The other key, and I know you're going to get us into later in the show when we talk about the difference between day trading and wealth building, but getting back to this is real money that you are when you do these allocations, it is your real money, right? So you've got your certain level of risk tolerance. You are also not trying to time the market and gain a lot of money this month. This is about wealth building over a career.
Yep.
Whether that's 5 years, 10 years, 30 years. This is about wealth building. If you talk to anybody that is wealthy, find someone that's truly wealthy and that made some of that wealth in the market. They're going to tell you the exact same thing. Like, you cannot get wrapped around the axle about 3% when you've got 30 years of work to do.
Yeah. Yeah, we are going to get into that
right.
into that thing. That I do.
I'm back on the chart.
So okay, you're back on the chart. Same one I see. Okay, so we're zoomed in.
I hope it's the same one you see.
Right. So we let me go to the pen real quick. Let's see if it works. We talked about this October 1st alert, and it really annoyed me when I had to put it out because I used one of our two moves on the first day of the month. I hate that. I hate when I have to do that.
Oh, nobody like that.
But if you look at the chart, I mean,
you got to do it.
When were you going to do it? That was the day that we opened up higher, came down, hit the 50-day again, and reversed back up to just below the open. But it's a great reversal day off the 50. I mean, you had to get in, had to, and it bore out some pretty good gains for the next week or so. But we were only 50% in, and I'm looking at patterns within patterns. So, as we talked about before, I expected the price to get back down to the 200-day moving average at some point. I didn't know it was going to happen, but I expected it to come back down to the 200. But since it's already above the 50 and the 10-day, I got to get in because if I'm, I don't want to have to prove. I don't want to be proven right. I want to be in. I want to be on the right side of the trend. And so on October 1st, even though I had to use one of the two moves, the market was telling us what to do, and so I did it.
And it went up.
And it went up. Great. Then it rolled over. Okay, that's fine, because that's plan B. So here's the thing, and it's unfortunate for us, for me and us, that it worked out this way. But here's the thing: the market rolls over, and here we are. Okay, it closed below the 10-day moving average, but the 10-day and the 50-day are so close together. We got support on the 50 and resistance on the 10. So it's kind of stuck. It's stuck. It's banging up and down on between the 50 and the 10, and you got to wait and see which way it's going to go. And unfortunately for us, the resolution of that pattern was down by like 3%, which was right there. Right? We had that big gap down. And now we were only 50% exposed, but still we had that big gap down. It was like 3%, so we lost about 1.5% that day, and it was a bad day. But that's the way the market works.
Yeah, and you got to, and I think you're getting to this. You've got to confirm that. You know, it happened. Doesn't, you know, and that's the closing day. That's the closing of that day. You wake up the next morning and
wake up the next morning and it's a new day. I mean, I can't erase and I can't use the pen when I'm zoomed in. Note to self. So you don't know. We had, yes. Do we lock in this loss? Absolutely. Could the market have come down to the 200-day? Definitely. Could it have come down to the 200-day, gave us a little something, and then continued down? Absolutely could have. Those are possibilities. It didn't happen that way.
Because it didn't. It happened that way not too long ago.
Yeah. Oh yeah.
So that's not historical. That's pretty recent.
That's pretty recent, and it could definitely happen that way. Now, however, it didn't. What happened was, even in the midst of all the uncertainty of the election and everything else, the markets turned back around before it hit the 200-day moving average, right? Turned back around. Then we had a day right there where it poked up above the 10-day, but ultimately closed right on it, right on the 10-day moving average. That was Tuesday. On Wednesday, it gapped up to open right above, well, pretty much right on, above the 10-day and right on the 50-day, and then went higher throughout the morning, right?
And that's when we said we got to get in.
That's when we had to get back in. I mean, you have to respect that move. Now, unfortunately, we are in the TSP. Yeah. We have to have our trade in by noon to get that day's closing price.
Market opens at 9:30 a.m.
Market was at 9:30 and it opened above the 10-day and the 50-day. So I'm looking at that and I'm like, all right, first of all, it's a huge gap up. It was already oversold, and that's why the gap up is there. No problem. It's gonna reverse. It's gonna come back down. You know, no problem. It didn't reverse and come back down. Right? It did, as you can see. You can see on the chart. It reversed because it went way higher.
Yeah, it reversed.
But it reversed later in the day.
Yep.
Right? We have to make a decision whether or not to get into the market, and we have about an hour and a half to do it and get that information out to everybody.
Yeah.
And so I know there was a lot of angst and frustration and discontent on Wednesday, and I appreciate it.
Yeah, we appreciate it because we're panicking just as much as anybody,
right.
and this isn't about kind of vindicating or whatever the right word is. It's more about being transparent.
Yes.
Like, hey guys,
I'm not justifying what I'm doing.
No,
I'm telling you up front what I'm doing. So there's no justifying here.
Hey, I was the guy sitting at breakfast with Jerry, right?
Whipping out the computer, making it happen.
I didn't even have a computer with me. It was in my truck down the street.
Yeah.
And Jerry's like, "We got to do it," and I was like, okay. And it is. And it's funny because the only person I can complain to is Jerry. And I go, Jerry, really? And he's like, dude, it's the market, not me. And I know that, right? So I'm running down the street to get my computer out of the truck, and he's doing, but hey, that's, and we're definitely not complaining because we enjoy this is why we do it. Yeah. But it is just, I tell you what, let's get all the people that watch this show and they're in our Facebook group. We got like 6,000 people in our Facebook group. Every single one of you write your congressman and tell them that the noon trading time is BS. Oh, my God.
Yes, please.
Write them, whoever the new one is, right?
Yeah,
if you got a new one,
yep.
Write them and say this noon thing is ridiculous. Okay, let's just call it 2 or 3, right? You'd have at least till, market closes at 4:30. Anyway,
honestly, I mean, if it was closing, I mean, there's no intraday price in TSP.
Yeah.
Right? We've talked about that. So you can't day trade TSP even if you wanted to because there's no. It's like a mutual fund. It doesn't exist. It only works on closing price.
The only reason we're seeing intraday is because you're using what it matches up against, which is the S&P 500.
Yes.
And yeah.
Yes. So if you could put your trade in any time during that day and get that day's closing price, that would be fantastic.
Mm-hmm.
Most of the time, we wouldn't need. I mean, if you trade if you're looking at the price after closing, you got all night and all the next day really to think through it. But if you could make the trade anytime before 4 o'clock and get that day's closing price, it's a game changer.
Which is reasonable.
It is. Well, Fidelity and Schwab and everybody else can do it.
Yeah.
Why can't the government do it?
Yeah,
right?
It's not the government. It was BlackRock, and we know that.
I don't want to get into all that.
Yeah. So if you guys want to get that changed, I think 6,000 people could do it.
Yeah, that's a big one. I mean, obviously the 2 moves a month is actually more important. But in this particular case, on this particular day, yeah, that getting your trade in by noon hurt a lot of people.
Yeah, because you have no idea what's going to happen after noon.
Right.
You're just having.
Well, you look at it. You can
have
see
to
it
do
on the chart.
You have to do it.
I mean, look at what happened. Get rid of this here. I wish I had an intraday chart of this day up and easily available. But look at what happened on that day. At the top of the candle, at the top of the white section of the candlestick, the wick is the line.
Okay.
So the top of the
Candle.
the candle, yeah, that was the price that we got back in at. Well, that was the price when we issued the alert.
Mm-hmm.
Okay. So what happened later in the day? It kept on going, but then reversed and came all the way back down to the top again, which is where it closed. Mm. Right. So we did have we saw a big reversal that day. I just can't like get across it. I don't know how else to say it. I mean, if you have to make this decision before noon, it's very hard. And then factor in how long it takes us to create the alert, get all the IT to work, and push it out to everybody, and everybody gets it because everybody knows that texting and email is in the queue.
Yeah.
Right.
We're sending out 1,000 some odd text messages and email. It doesn't just go
right.
like me sending you an email. But anyway, I mean that kind of it feels like we're making excuses, but it really is about being transparent to our members and letting you know the process. And there's a great post that Jerry did about the mechanics of an alert. We've made it kind of like standard reading now that we're going to send it to every new member. But the point is that what because we're hard on ourselves too when stuff like this happens. But one of the things I had to kind of explain to myself and Jerry and I talked about it was that who else who else could be expected? Like how there's no way without the knowledge and the validation that I have of that alert, I wouldn't have felt comfortable making that decision because I'm just not. I don't have enough information. Right? Me personally, right? Even though I do this along with Jerry, right? So you know what? At the end of the day, you just got to do what the market tells you to do. That's really what it is, and it's not emotion. I know we need to get into that stuff because that's important stuff.
Yeah, that's going to have to be a different show, but it is important stuff. All right, let me try to get back on track to where my notes were.
Yeah, I sidetrack us. It's what I do.
When I write the notes, I know I have a progression.
And Conan messes it up because I don't have those notes, and I just like to talk.
Yeah. All right, let me see.
Anybody that listens to this show and knows me knows I like to talk.
All right, so we were looking at this relatively short-term view of the market, right? The W that we talked about. So I think you get the idea that I'm working on the moving averages, and that's it. You get the 28 October. We went to 100% G. The market did not continue lower. That's fine. Plan A was the expectation that the market was going to come down to. Plan A was that we were going to come down to the 200-day moving average, and then I expected to buy back in. It didn't happen. It reversed, went higher. On Wednesday, it gapped up. We put out the alert. Great. Does it go higher from here? I don't know.
Yeah, because we're still not above. We're not higher than the
3,600 is really the line that I think gets us out of the bigger pattern.
Yes.
And we're going to get to that in a second. But if you are, so here's the thing. I don't have a problem, quote unquote, locking in losses. Okay. Because I know I will always make up more than that when the market comes back. And I can sleep well at night right? Knowing that my losses are capped. So it's one thing to say I locked in the losses. That's true. It's also true that I have capped my losses. I'm not going to make any more losses. Okay? So when we look at this 28 October, and you look at it and you go, we got out, and the market immediately turned back around and went up. Yes, it did, and we did not get these gains right here because it took us until Wednesday to get back in. But who wouldn't have thought that wasn't a possibility?
Yeah, and not only because if you A, watch our show, or B, do this on your own, everything it's probable it was going to go down.
Yes.
Not possible. It was probable. It was highly probable. It didn't because it's the market and it did what it did. But the point is because the time frame is condensed, right? The thing that we talked about the other day with,
right.
If
there's a 25% move down,
yeah.
you were better off. But because this was only a 10% move. So we're at 3,600, 10% is 360, 3,600.
Yeah, generally, this is going to work out way more in our favor to do this. So that's the way you have to play it. And if we were to have gotten in any earlier, we would have been trying to time the market.
Yeah.
We would not have been making a decision based on data. Because if you jumped in at the bottom, there's nothing there that tells you to jump in.
No, it's a complete guess.
Yeah, that is 100% timing the market, and it doesn't work.
It's a guess. I don't even know why they call it timing the market.
Yeah.
You're just guessing.
It's luck.
What would make you think that the market just gapped down 3%? What makes you think it's going to stop right there? Like,
what did you say earlier? That's just pulling the lever.
Right, it's Vegas.
Like, ching, ching,
it's
ching,
Vegas.
ching. That's all you did. And if it went up, great, you were right. But if it didn't go up, nothing there told you to do it.
No, until Wednesday when we gapped up and broke through.
That's it.
That's it. So that's why we're back in.
All right.
And we got the technical indicators down here. The MACD broke positive. The RSI was already moving higher, and we broke above both the 50 and the 10-day moving average. No guarantees that it moves higher from here, but the probability is high, which is why I got in. So when people say I missed the move, what should I do? The risk for you, if you missed the move in the short term, this time frame, the risk is higher because if you get out, you're going to lock in more losses. But it is what it is. It really doesn't.
There's nothing right this minute. There's nothing as of closing today. There's nothing telling us which way it's going to go.
Right. And we're still within this 10-day, 10% window. So basically, 3,600 down to what did I say it was? 3,240 is 10%. So if you take 3,600 and subtract 360, you get 3,240, which puts you right there. So there's your 10% range. Okay. And you have to accept that anywhere in there, because it's a consolidation.
Yep. It is clear. This is a consolidation. I know 10% of what Jerry knows with technical analysis, and I look at the chart and go, okay, it's consolidating. It's going left to right.
Yeah.
Ziggy-zagging.
If you want to wait and get back in down there at 3,250 because it's close to the bottom, and you can make back that 10%, awesome. Yep. Go for it. But
just know why you're doing it.
Yeah. I mean, if the market doesn't roll over, and it goes higher, which is what we expect to happen, or not that we expect, but that we're positioned to have happen.
Right. Plan A.
That's our plan A. If it doesn't happen, believe me, we're getting out.
Right. And that'll be our second move for the month.
Yeah, that's the way it goes.
And then the rest of the month, we got to sit on our hands because we didn't make the rules.
Exactly. So, fine. I think you guys get the idea.
We haven't made it past the first chart.
Yeah, we're getting there. The last few are gonna go by quick. So these are all very short-term, sort of real-time decisions that we've talked about on these 5 alerts. And if you look at it, we had big gains here, right? on the 31st of August, we took 55% of our gains. We locked them in. Okay. So we took 45% of this loss. We got 50% of this gain. We did not get 50% of this loss, right? But this is a wash basically right here. And then we got in right here. So we did a lot of work. But what you don't see, and Conan's going to hate me for saying this, so we did a lot of work, and essentially it was, if you had stayed in and rode it, it was basically a wash. But what in reality, you got out here and you capped your risk. So if the market had gone down, you would not be exposed to it at all.
Yeah, and there was not only was there nothing telling us that it wasn't, a lot of things were telling us that it was going to go down there.
Right.
I mean, if you want to go listen to the fundamental analysis, folks, which is all the talking heads on Bloomberg and so on, that's all they're talking about right now.
Yeah.
All they're talking about right now is the market's going to go down. We're about to get some bear. Right?
Yeah.
Right. And but so not that we listen to it or make our decisions based on that. We do listen to it. We make our decision based on that. But so everything's telling us that it could go down. So you've locked it in. You're good, right?
Right. Once you've locked in, did we lock in? So if you're from here to here, right, and you say this is where we got out at, did I lock in those losses? Well, yeah, you locked them in, but you also locked in the gains, right? And you locked in the but you locked in the reality that you're not going to have any more losses. So, and then the market turned back around, gaps up above the 10-day and the 50-day, and we get back in. Great. So now we're in, and we'll see which way it goes. So anyway, if you're somewhere in here and you're not in sync, don't sweat it, is what I'm saying. You get this 10-day range, 10% range in here. If you want to get in sync, get in sync. If you want to wait until the market comes back down to some level, wait and then get in sync. It's up to you and your personal risk tolerance. A few percent one way or the other, it's not going to break. It's not going to break the bank. And to be honest, that's the point here. If I'm worried about losing a few percent at the top or not getting all the gains off the bottom, then I'm thinking like a day trader in a wealth building game. Okay, it's like trying to play baseball on a rugby pitch, right? It doesn't work, right? They designed the TSP to be a wealth building vehicle, right? Then they forced it by instituting the two moves a month rule and the have to have your trade in by noon to get that day's closing price rule. So if you you have to think about it as a wealth builder, not as a day trader. Okay. If I'm a wealth builder, right, I want to avoid the market collapse like this bearish scenario looks like. This is the chart we put up last week. I didn't change it at all. It's the same chart from last week. This is what we're trying to avoid. Okay. That's a 40% move to the downside. We are trying to avoid that. I'm happy to lock in 3%, 5%, whatever losses on a short-term chart to avoid a 40% downside move.
Yep, and that's not timing the market. That's analyzing the data. Yeah. That chart is showing us that there is a high probability, just like all the fundamental analysis folks are talking about right now, there's a high probability that we're about to hit a bear market going down.
Yeah, I mean, we listen to those people, and it's entirely possible, and you have to have plan A, B, and C, and this is the bearish scenario, and
we might get the bullish scenario.
We might see that in the next chart, but I'm just saying, if I'm a wealth builder, I want to avoid this bearish scenario. Yeah. If it costs me a couple percent, fine. So I'm okay with locking in some losses if I'm able to avoid this 40% loss. Okay. On the other side is the bullish scenario, right? If I'm in the building wealth mentality, I want to be in the stock funds as soon as I have enough confidence that we're in this bullish scenario, right? If I'm building wealth, I'm okay with not getting in at the very bottom, right? Like right here is where it was on this chart, and perhaps it's going to turn out to be there. But I'm okay with not getting in at the very bottom. I want to get in when I'm confident that the market is going to trend higher from where I am, right? And that level of confidence and the corresponding price where you decide to get into the stock funds depends on your personal risk tolerance. Okay?
What are you willing to risk with your money to build wealth?
Yes, and you have to know the long term and the short term, and you've got to be able to play both games, both sides of it. All right, I don't know why it's not coming up my notes, but this idea of getting sucked into the day trading mentality, it's easy to do.
It's what we see. It's what we see on TV when we watch all of these talking heads, talk about this.
Yeah.
They're talking as if they're day trading, and many of them are.
Yes, a lot of them are.
Because and this is the key thing. And again, we do all this to educate. The majority of folks. There's 5 million people in the TSP. Yeah. 5 million people, and we know 99% of them get no education, no information on how to manage the largest chunk of their retirement. We know personally because we've done it.
Yep.
I've retired and he's about to.
Yep.
So the point is, most of you don't have that information, right? And if you're going to build wealth, you're going to build a pot of money to retire from. You do that over time.
Yep.
The system is set up not to day trade.
Right.
2 moves a month. Got you have your thing in by noon.
Yep.
It's not set up for that, right? So if you know that, if you know the boundaries you're working in, your left and right limits, for those military folks that are listening, you know your left and right limits. Work within them. Don't fight them. Don't worry about them. Work within them, right? And you'll be fine.
Yep, absolutely. Absolutely. This, if you guys remember from last week, was the ideal sort of the ideal of the megaphone pattern, right? So if you look at number 1, it's starting to look like this is where we are. Okay? It's not confirmed yet, but it's starting to look like that's where we are. So I'm not 100% sure that the market is going to move higher from here. There's still plenty of uncertainty. However, the explosive price move on big volume through the 10-day and the 50-day moving averages all indicate to me that the market will move higher from here. If it doesn't, not a problem. We'll readjust, right? I don't need to be right. I just need to be able to transition quickly from plan A to plan B to plan C as the market tells me to do it. So the bottom line, wealth builders want to position themselves for long-term gains while avoiding significant losses. That's really the point of the last 3 slides. If you're building wealth, you're going to take those 1, 2, 3, 5% hits because that's what makes you confident in the direction of the next move, right? So tempting as it can be, do not fall into the day trader mentality on a wealth building field. You will not win the game. Back to my kind of playing rugby on a baseball field or vice versa.
Yeah.
Any questions about any of that?
I got tons of questions, but we don't have enough time.
Yeah, we don't have time. All right. So that's the end of the really cool stuff for the show. We're gonna roll quick here through this. So we got the C Fund 1 year daily. We had indicators. The MACD definitely crossed higher. We got the RSI is already moving higher, but it still has room, right? You can see back here in September at the high, we were pretty overbought on the RSI, and we have a lot of room to go. So the price can definitely move higher from here. Friday, let's see, let me zoom in here. On Friday, we have a low volume down day, which is exactly what we want to see, especially after having this big move higher this week. And then Friday, it just barely was down, and it was down on low volume. Exactly what we want to see. And it just furthers the expectation that prices are going to move higher going forward. Doesn't guarantee it, but they definitely makes me feel good about it. That was the C fund. S fund, okay. C fund, you can see we are still in this sort of consolidation, right? It's definitely a consolidation. And at some point down the road, we're going to talk about how 1, 2, 3, 4, 5, A, B, C. Okay. If this thing explodes higher, it's going to be very simple. 1, 2, 3, 4, 5, 1, A, B, C, 2, and then somewhere up here, way up there, is going to be a 3. That's the best bullish case for the market right now. And obviously, that's where we are positioned. That's our plan A. That's where we're positioned in terms of the. Why isn't this erasing? That's where we are positioned in terms of our alert. Looks different from the S fund. The S fund is still has higher highs and higher lows. So it's still in an uptrend, an upward moving pattern. S fund's doing great, which makes sense because S fund is small cap tech. So it's not Amazon and Netflix and Google. It's smaller tech, but tech is crushing it. And S fund did really well this week, along with the big cap tech names. So that makes a lot of sense. The I fund, so S fund still, MACD went positive, RSI is good, still has room to move higher. It's all good. The I fund is interesting. We've been talking for months, literally months, about this horizontal channel on the I fund. At the low, at the end of October, right, which was just last week, at the low, we had this, and we talked about it last week. We had this one day where it closed below the channel, but it closed at the 200-day moving average. So I was hesitant to say to bail on it because we had support there at the 200-day moving average. So I gave it another day, right? And what happened? This week it exploded higher, and on Friday it closed right above that channel line. So where does that leave us? We had a head fake to the downside. Do we have a head fake to the upside? I mean, 66 is the number, right? $66 is the number, and it's closed at 66.21. So it's not far enough outside the upper trend line, upper channel line, for me to get back into the I fund. But it's right on there. I mean, one more day of positive, price movement for the I fund, and I'm not saying I would reallocate because again, we only have one more reallocation in TSP, but we could definitely see a breakout on the I fund, and that's awesome. Okay, because like we say, the idea is that the stock funds all more or less rise together and they more or less go down together. So it makes sense that they're all moving up together. The F fund. The F fund, on the other hand, does not look anything like the CS or I charts. And we haven't been in the F fund for a while. But this is a pretty interesting chart because we had a big gap up above the 10-day and the 50-day, right? And the market moved higher. And then it came back down. Let's zoom in a little bit. We get support there at 117, right? Then we had a huge gap up to 170, almost to 118. Then one more day higher on Thursday, and then we came back down on Friday and tested the 50-day moving average, and we got support there. It reversed higher. So the F fund is actually looking pretty good. I wouldn't be in the F fund versus the stock funds right now. But if the stock funds rolled over and the F fund held above the 50-day moving average, it would definitely be something, an option I would look at versus going 100% G. But that's something that if and when the stock funds rolled over and, the next time there's a correction, we'll look and see. And if you're a subscriber, you will get the word via an alert that hopefully comes out a little bit earlier than it did the last time. Okay. Nope.
Got to zoom out.
Thank you, sir. All right. That's it. That is it. All I got for today. So I still hope your candidate wins, whoever that was. Yeah. Since we don't know yet.
Hopefully by the time this comes out, that's all over.
God. I hope so. It's Friday night, just so you all know. This thing comes out on Sunday. I hope we know by Sunday.
Jared will be flying all over the place the rest of the weekend.
Yeah, I'll be out of town.
Yeah. All right, guys. Well, as usual, we hope you got some value out of that. If you did, please share this with your friends.
Share with friends.
Spread the love. Get the information out. We're trying to help as many people as we can. Educate them so you can build wealth and retire when you want to.
Exactly. Next year.
You ready?
I'm ready.
I'm already there.
You're already there. Yeah.
All right, guys.
All right. Have a good week.
Have a great week.
Peace.